Well, hello everyone and welcome to the webinar. My name is John Bowens with Equity Trust Company. Very excited about today's program. For those of you that are avid viewers of our webinars, you'll find that this is a little bit more unique webinar than what you might be accustomed to. Many of our webinars are educational based in terms of understanding how to use a self-directed IRA, how to affect transactions, what a self-directed IRA is, and the different types of investment options that may be available to you. We'll certainly go through some of those learning lessons as well. So for those of you that are brand new to the concept of self-directing into real estate or other alternatives, you'll get a little bit of a flavor of how that works. But for those of you that are existing clients of ours, or even if you're not an existing client and you've been involved in our webinar series, you'll find that this is very, very unique in the sense that we're actually providing a lot of data and a lot of science behind what our clients are doing with their self-directed IRA in the real estate marketplace. And over 40 plus years in the business, we've been able to aggregate a lot of data over thousands upon thousands of transactions with thousands of equity trust clients. And a lot of the data that you'll find in this particular webinar is from 2008 to 2018. But we could even go further back and really provide a lot of intelligence in terms of what clients are doing, the various trends as it pertains specifically to real estate investing. Now, of course, Equity Trust as a alternative asset specialized custodian, if you will, we allow our customers to invest in a wide array or variety of alternative assets. Everything from real estate, as we're talking about here. We'll talk a little bit about notes, investing in private equity, startups, venture capital, investing in even digital currency, investing in precious metals. So there's a wide array of alternative investments, but we're going to stay very specific to real estate investing in this particular webinar. I do have some outcomes. I want to make sure that we frame this training properly so that everybody can get the most out of the program. So the first thing is we're going to talk about equity trust clients and the insights from 2008 to 2018. And the reason why we're sharing this data and sort of this science behind where our clients are investing and maybe how they're investing is so that you can better plan for 2019. So as you're creating your 2019 investor plan, and maybe it's not just 2019, maybe you're creating a 5-year plan or a 10-year plan or a 15-year plan, and you're looking at the different types of accounts, which we'll talk about as well. Traditional, Roth, SEP or solo 401k or simple IRA, a covered education savings account, health savings account, and how you're arranging these different plans and creating more tax advantage dollars and then deploying them into real estate investment opportunities. We want to make sure that we give you some information and some guidance on how to potentially create a plan. Now, of course, we're not here to serve as your advisor or your financial planner. You've probably heard that before if you've been on our webinars or you've spoken to an equity trust representative. We're a passive custodian, but we want to give you some concrete, if you will, starting points so that you can better plan for 2019. Okay. The next is, and this is very, very important in the training programs that I've provided over the years, and I've seen a lot of clients be able to accomplish quite a bit by getting over this notion that they don't have enough money in their IRA to invest. I can't tell you how many folks that come to my one-day class on Saturdays. We host these all across the country, and they come in the door at the beginning of the day and they say, wow, I can't invest in real estate with a self-directed IRA. I don't know that this class is right for me because maybe I only have a few $1,000s in an IRA, or maybe I only have $15,000 in an IRA, and in my market, the property median price is $40,000 to $45,000. And so throughout this training, I'm gonna sort of debunk that myth and show you how some equity trust clients have effectively partnered their IRAs with their spouse's IRAs, with their various other retirement plans, in order to be able to affect real estate transactions. So, certainly we don't want anyone to come into this training thinking they don't have enough money in their IRA there are methods, there are various options that you could potentially explore. And then last but not least, I do want to make sure that everybody leaves today as we go back to the 2019 plan, understanding who you want to start looking at for building a real estate investment team, if you will. So if you're going to go out and affect real estate transactions with your self-directed IRA, there are key players that you need to have on that team. And I want to make sure that I provide some additional details and information on how you can start to populate that into your 2019 and then beyond plan. Okay, before I dive into the data and sort of the science and we do a couple learning case studies, I do have to make sure that I provide this disclaimer that Equity Trust Company is a passive custodian. We're not here to provide tax, legal, financial advice. We're not here to be your fiduciary, your financial advisor. We're a non-discretionary, non-fiduciary custodian. And that's very important for our viewers to understand. When they come to Equity Trust Company, our investors have the peace of mind and understanding that Equity Trust Company is here to allow them to invest in a wide array of alternative assets. And we're not performing due diligence. We're not doing a review from a legality perspective. Ultimately, it's up to the investor to make all those decisions on their own, which can be good in the sense that it gives that investor more freedom and more flexibility. They have the ability to go out and self-direct their own retirement plan without having restrictions on the account in terms of only being able to invest in, let's say, stocks and mutual funds, which is what most people are accustomed to. Equity Trust, again, offers a wide array, if you will, of options. We don't solicit those investment options, but rather a customer can come to Equity Trust Company and invest in everything from stocks and mutual funds if they still want to do that. We have the capabilities and technology functionality to do that here. And then, of course, invest in real estate, notes, and private equity, and all of the other various alternative assets that we talk about. Okay, so that being said, I do want to mention that this report that I'm going through, it will also be available free of charge to all of our viewers. If you would like a download of this free report, just email us at webinars@trustetc.com and we'll get that report right out to you. Okay, so where are our clients investing in real estate? And I think that this is a real critical slide, an interesting slide to present as we kick things off here. So as you can see, by region in the Midwest, of all the transactions, all the real estate purchases from 2008 to 2018, 27% of those transactions were in the Midwest, 50% in the South, 9% in the Northeast, and then 14% in the West. And as I dive a little bit deeper and get a little bit more granular, we're going to get into median and average prices in these various regions. And we're also going to look at folks that bought properties out of state, so out of state investors. And you're going to start to see some of those trends unveil themselves as we go throughout the training. Okay, so again, 27, 9, 50, and 14. Really, when we get into the averages and medians, it won't come as a big surprise why some of those markets have a less concentration. Okay, where are clients purchasing real estate? Top 10 states. So you can see California, Texas, Florida, Ohio, Indiana, Michigan, New York. You have the Carolinas in there and Georgia. I'll point out the largest state you can see there is Florida, the state of Florida with 12% of all transactions being affected in that particular marketplace. All right, types of properties purchased. Now this is an interesting one. This is broken out by the same regions that we presented before: Northeast, Midwest, South, and West. And what we wanted to do in pulling this data is we wanted to understand, are our investors buying and holding real estate, buying rental properties, and then also buying and holding for appreciation for then eventual resale, or are they flipping properties? And what do those trends look like? And so this is the raw data from 2008 to 2018, and you'll see that in the Northeast, 60.6% of all properties purchased were rental properties. And how we defined rental properties was that the property was owned for 1 year or greater, and there was cash flow coming into the account. All right, we can make the assumption that that would be a rental property. Your bought and held, if you will, properties. Those are properties that were bought, they were held, but there was no cash flow coming in. So that would be like your raw land acquisitions, for instance, or potential property that was being bought and held onto without any cash flow, with the expectations for appreciation and then eventual resale. So in cumulative, you'll see that you have rental properties and your bought and held in the Northeast comprise about 80%. So in the Northeast, about 80% of all properties were bought, likely with the intention to buy and hold those properties on behalf of those particular clients. In the Midwest, where our home base is in Cleveland, Ohio, right outside of Cleveland, Ohio, in a western suburb called Westlake, Ohio. That's where our company headquarters is at. You'll see here you have rental properties plus your bought and held. That's closer to 85%. So as you can see, 16% of all properties in the Midwest are being bought with the expectations to potentially rehab and then resell in less than 12 months. And to go back to the properties flipped, these would be properties that were bought and resold within 12 months, so in less than 12 months. When we go to the South, the data is fairly consistent. You'll see we have about 80% are bought and held in the South, about 20% flipped, and then you do see that change when we get out to the Western regions. And the picture will be painted when you look at average prices, and a lot of people can make these assumptions as well, knowing what property values typically look like out west. And you'll see there are only about 10% of properties were flipped out in the Western region. Okay, what I want to do now is dive into, as we talked about the Midwest and South and West and Northeast and buying and holding versus rehabbing. I want to present just a quick case study for those of you that are especially new to the concept, understanding, okay, how do I actually do this? What does this actually look like? So I have a case study from an investor here in Ohio, in the Cleveland area. His name is Gary. And Gary and his wife Candace, I have another case study for his wife Candace. Gary and Candace established self-directed IRAs about 6-7 years ago. And they started with just a little bit of money in the account. In fact, Gary started with only about $5,000 in a Roth IRA. And he was able to acquire this property. You'll see he bought it for $68,000. So it did take a few years for Gary, through contributions to that Roth IRA, and then also partnering that Roth with other retirement plans within the family, in order to get it up to a balance where he could go out and buy a property 100% outright with the Roth IRA. So this was within the last couple of years. Gary bought this property for $68,000, and this is in Ohio. It's a duplex, and he bought it for $68,000 at a county auction. So this was a foreclosure. It went to the sheriff's sale auction, and if you will, he bought it at the courthouse steps. And the way in which he did this, he came to Equity Trust Company. He has this self-directed IRA, Roth IRA with Equity Trust Company. He received a check for the down payment, which was $5,000 at the day of the auction. And then within a few days, he was able to get the remaining balance needed and wire transfer the funds out to the county for the full purchase. So IRA money leaves the account. In return for that IRA money is a deed to the property. And that deed to the property isn't in Gary's name or Gary's LLC's name. It's in Gary's IRA's name. So it's Equity Trust Company, custodian, FBO is in for benefit of, Gary's IRA. And that's important to understand for those of you that are new to this concept, that when you're affecting real estate transactions, those transactions are in the name of your IRA. You're not titling those in your name or titling those in an LLC's name. That's also a very important learning lesson here, because if you don't have a self-directed IRA open and funded, and you need an earnest money deposit, you could potentially miss out on a transaction if you don't have that account open and funded. So I would encourage folks, if they know they are interested in doing this, to have their accounts open and funded in advance so they can quickly execute on purchasing real estate. Getting an earnest money deposit from the account or a down payment for a county auction sale like this particular transaction, and be able to move efficiently through that process. So Gary bought the property for $68,000. I put about $20,000 worth of work into the property. It is important to know that if your IRA owns the property, your IRA must pay for all purchase and rehab from the very beginning all the way through the entire transaction. So all carrying costs, taxes, insurance, HOA dues if applicable, and then of course any improvements necessary must be paid for from the IRA. Now what's nice is Equity Trust Company offers a technology platform, we call it My Equity, which enables a client to effect a real estate transaction through the online portal, sending an earnest money deposit out within 24 hours if needed via check or ACH, as well as paying for all expenses related to that property. And we have the functionality and capability to issue a check and send it out, as well as send an ACH deposit. So if you had a contractor, or in this case, Gary, let's say he had to make a contractor payment of $2,000, he could simply go online or via his mobile device, log into his My Equity portal, say, Equity Trust, I need you to send X amount of dollars to XYZ Contracting Company, and then we effect that transaction and we send that money out. Okay, so he puts about $20,000 into the property, and he's making currently about $900 per unit. So he is holding this as a rental property, and that's about $1,800 gross a month. The last time I spoke to Gary, after all expenses, property management, etc., he's netting around $1,400 a month. So he's got about $1,400 coming into his Roth IRA every month. And what's important to understand, because it's a Roth IRA, it's tax-free income. Gary will be 59 and a half in a very short period of time here. And when that occurs, should he still own this rental property, all of that $1,400 coming in every month is tax-free. And should he choose to do so, because he'd be 59 and a half or older, he can take that money out every single month 100% tax-free. So what he's doing with his Roth IRA, with a cash flowing asset, is he's able to create a stream of tax-free cash flow. And none of that income hits his 1040 as ordinary income and then paying taxes accordingly. So if he sells this property, which has a ARV of about 135 to 145, if he sold this property, that would all be profit going directly back into the Roth IRA tax-free as well. So when he sells the property, there's no long-term capital gains tax because it's in the Roth IRA tax-exempt vehicle. And of course, there's no recapture depreciation or other type of taxable income. Okay, Candace, Gary's wife, this is a buy, fix, and sell. A very similar type of transaction. We're going to go through this one a little bit more quick. In this transaction, she bought it for $80,100. And this property was also bought at a sheriff sale auction. Same process. She effected her transaction through the My Equity system. She got a check ahead of time for $5,000 to have in hand at the county auction. And then I believe it was within about 14 days, she sent the wire transfer to the county for the final purchase. In it for $8,100, put $18,000 worth of repairs into the property. Same process there, using the My Equity portal. She was able to process all of those transactions, sending checks out to her contractors as needed. Total investment, $98,100. They sold it for $144,900. Oh, by the way, this property in August of 2017 was listed for only 24 hours before it was an offer was accepted. Closing costs $10,000. They made a net profit approximately of $36,800. So they were in it for $98,100, and they had net profit of $36,800. So as you can see there, over a 36%, if you will, return on investment. Okay, moving on to that recaps sort of the again the Midwest region. If we go to the northeast region, I want to talk about the median and average purchase prices. And the reason why I have both average and median here is because you'll see that if you look at the median, which is $39,000, and then you look at the average of $74,000, may not necessarily, from a statistical perspective, be the best picture to paint if we're only sharing a median value. So it's important we're looking at both the average and then we're looking at the median, and we broke it down by the rental property purchases. Again, these are purchases where the property is held a year longer and there's income coming back in. And then you have your flipped property purchases, and then you have your buy and hold, which there's no cash flow coming in. Likely it's one of our investors that's just looking to buy for longer term appreciation. So you can see the average purchase price, and I'll take a moment just for you to put your eyes on this. You'll see the average purchase price per rental, per flip property, per buy and hold, and then of course your median purchase price. And when you look at the discrepancy or disparity, if you will, between average and median, that would conclude that there's a pretty broad spectrum of values of properties being bought in that northeast region. Okay, back to the Midwest. When we look at average purchase price and median, and you could even tie this back into the two case studies that I presented just a moment ago. The average purchase price is $51,000, and the median is $32,000. Same there. I'll just take a moment to let everybody put their eyes on this screen and look at the values. I did find this interesting here on the rental properties in the Midwest. You have $52,000 as the average purchase price, and the median purchase price is $32,000. And then what I'm going to do is toggle back here to one of our first slides just for a moment and show you again where the top 10 states. Ohio, 9.3%. Again, that's where Gary and Candace are located, 9.3%. So you can assume a decent amount of those numbers are coming from the state of Ohio. Okay. All right, so that's the Midwest. And I want to present one more case study from Gary and Candace. This particular transaction was affected by Gary's IRA. Now, I mentioned before that there was a point in time where Gary didn't have enough money in his IRA to buy a property 100% outright. And I mentioned at the beginning of the webinar that I was going to present to you, if you don't think you have enough money in your IRA, there might be ways in which you could put together transactions. You could carve out and architect transactions. So on this particular transaction, Gary partners his Roth IRA with his non-IRA money. So in this transaction, he has his Roth and he has his non-Roth money, his non-IRA money, coming together in a tenant in common ownership, buying the property, renovating the property, and then reselling it for a profit. Now, quick disclaimer, it's important to understand, and we're not going to get into the discussion in this webinar about disqualified persons and prohibited transactions, but it's important to understand under the purview of the Internal Revenue Code 4975, Gary, as an account holder, as a fiduciary to his IRA, is considered a disqualified person. Disqualified persons cannot transact business with their IRA. So if a disqualified person is going to partner with their IRA, they have to make sure they proceed with caution. They have to make sure that everything is done proportionally, meaning when they buy the property, there's proportionate ownership interest. All expenses paid are proportionate, and all profits go back into the respective IRA and to the individual proportionally. Now, this would be a place where I would mention that you would want to speak to possibly a CPA or maybe even a tax attorney as you go through these types of transactions. But let me walk you through the case study here. Roth IRA put in $31,125. Cash that was put in the deal was $10,375. So it came out to be a 75-25% split, if you will. So Gary's Roth IRA was on title as a 75% owner, and then personally or with the LLC had the remaining 25%. Total repairs were $30,000. So same goes there. It was a 75-25 split. So 75% of all the expenses were paid for from Gary's Roth IRA, 25% from the non-IRA money. Total investment in the deal, $71,500. Sold it for $116,000. Closing cost of about $10,000. That was a net tax-free profit back to Gary's Roth IRA in the amount of $25,875. And cash profit of $8,625. So the $8,625, of course, would be taxable short-term gains tax to Gary or through his LLC. And then the remaining $25,875 was in the Roth IRA tax-free. And again, as I mentioned before, Gary's approaching the age of 59 and a half, at which point in time, all of that money in the Roth IRA is tax-free. So as he begins taking distributions, he has that rental property like I talked about. He's got $1,400 coming in every month, and it's rinse and repeat. $1,400 in. If he wants to take it out, he can take it out 100% tax-free, ultimately creating tax-free cash flow. All right, moving on to the South region. And this is interesting. You start to see the values compared to the Midwest up slightly, but when you look at the median, it's fairly comparable to the Midwest. So when we look at rental properties, average purchase price $74,000, the median purchase price is $47,000. You have your flip properties here, buy and rehab $72,000 and $51,000, and then your buy and hold. These would be transactions where no cash flow is coming in. It likely are properties that are being bought and held onto for appreciation, 63 and 31 respectively. Okay, then we wanted to look at the West, of course, and you see property values much higher than the other regions that we displayed, or particularly the Midwest and South region. Average purchase price, $93,000 on your rentals, median $54,000 on your rentals. The flip properties, rehabs $94,000 and $51,000 respectively. Your buy and hold $70,000 and $31,000. And I'll just leave this up for a moment to let you put your eyes on it. And you'll see there that West region does include Alaska as well. Alaska and Hawaii. Okay. Now, the next thing that we wanted to do is, and as we dovetail into the next slide and sort of tie it back to the beginning slide as well, is the overall median price in 2018 was $53,000. So that was the across the board. And we wanted to break it down and look at the top 10 and bottom 10 states. So you can see there the top 10 states in terms of median price. $163,000 starting with Idaho, working our way down to Oregon, Utah, Colorado, Hawaii, Rhode Island, Vermont, Montana, Nevada, New Jersey. And I did have someone mention, I'm surprised California wasn't on that top 10 list. And I think what in the next slide will speak a little bit to that. Bottom 10. Kansas, Illinois, Missouri, West Virginia, Kentucky, Arkansas, Mississippi, Louisiana, Nebraska, and of course Ohio. Ohio, which again were the case studies that I mentioned just a moment ago. Okay, so, and this is a slide I want to spend a little bit of time on, and this when we go back to the initial slide and we toggle back and forth, you'll start to be able to draw some conclusions here on sort of what's going on and the trends that we're seeing. So properties purchased by non-residents versus average purchase price. So what I wanted to look at in pulling this data is understand our self-directed IRA investors with Equity Trust Company buying properties out of state. So there's been sort of this emerging marketplace for out-of-state investors, particularly we could say, let's say, investors in California. So knowing California real estate and understanding the values in that particular marketplace, it likely is challenging for an investor to buy and hold for cash flow real estate in California. Same goes for, let's say, Colorado. In fact, I was teaching a one-day class in Colorado And this was about a year ago now. And a lot of the investors that I spoke to at this class who were more buy and hold for cash flow investors were not buying properties in the Denver market or really anywhere in Colorado for that matter due to the cap rates and it just not being economically feasible for them to acquire buy and hold real estate. And one of the investors in particular was buying properties in Oklahoma. And as you can see there, the average purchase price is $56,000. So this gentleman owned, I believe it was about 13 or 14 rentals in Oklahoma. So he makes commutes to Oklahoma. He worked with a real estate broker directly who's sort of boots on the ground, finds good rental property opportunities, buys them at a discount, fixes them up, places a tenant, hires a property management company, and then he has cash flow coming into his Roth IRA 100% tax-free. So that's just one sort of anecdotal case study that I can mention. So let me show you, let me go to some of the blue states. All right, if we look at North Dakota, 83% of properties, and this is what this means, 83% of properties bought in North Dakota were from out-of-state investors. So we can't really draw all the conclusions here, but ultimately there's something going on there that is driving out-of-state investors to buy properties in North Dakota. 83% average purchase price is $55,000. In Nebraska, 79%. So again, 79% of all properties amongst our self-directed IRA population, self-directed retirement account population, were bought from out-of-state investors in Nebraska, and the average purchase price you can see there is $85,000. In Arkansas, 61% out-of-state investors, average purchase price $35,000. Nevada, 54% out-of-state investors, $77,000 average purchase price. Alabama, 48%, $76,000 average purchase price. Tennessee, 41% for a $58,000 average purchase price. Indiana, 40%, $49,000 average purchase price. And so one of the things that I wanted to mention here, I said this sort of emerging marketplace of out-of-state investors. We've also found that there are a significant number of passive investors who are not looking to per se buy, hold, manage, kind of do all of the legwork themselves, do all the administrative work themselves. They're potentially looking to be more of a passive investor. And if they're in a state that they may not be able to acquire good buy and hold, good cash flowing real estate, they look to out-of-state opportunities. And there's this concept or this investment strategy called turnkey real estate that some of you may or may not have heard of. And really the concept of turnkey real estate is finding turnkey real estate operators. These are companies or individuals, could or could not be associated with maybe like a broker, that acquire real estate. They fix the properties up if needed. They place a tenant. It's cash flowing, and then they sell those cash flowing rentals to potential investors. So it's a more passive approach for an investor. And so we've seen this in the past, and I can't absolutely draw the conclusion, but I can with pretty good certainty make the assumption that a lot of these acquisitions that we see here are from out-of-state investors are likely them going through one of these per se turnkey real estate operators. And again, I go back to bullet number 2 in our outcomes. I don't have enough money in an IRA. Some investors may not have enough money in an IRA for their particular marketplace, but there could potentially be the ability or capability of them going out to another marketplace, another real estate investment marketplace, finding a turnkey real estate operator or broker, doing the necessary networking and due diligence, acquiring real estate in that marketplace, hiring a property management company, and then net cash flows are coming into the IRA in a tax-advantaged fashion. Okay. Quick case study as we talk about out-of-state investors and are people doing this. This is Al from Michigan. He joined us on a webinar not too long ago. He talked through this transaction in a little bit more detail. I'll just give you the high-level bullet points. L did this entire transaction essentially from the comfort of his own home in Michigan. I don't believe he spent very much time actually down in Hilton Head looking at the property per se, or managing contractors or doing anything of that nature. He hired out all of that work. It was more of a passive investment, if you will. So this property was bought. It was a condo, or is a condo, in Hilton Head, South Carolina. Bought it with his self-directed IRA for $37,500. Put $8,500 in rehab into the property, and it's renting out for $1,390 a month. And he initially, when he got the tenant in, that was a 3-year lease. The appraised value of the property in 2017 was $75,500. So $13,900. You could ultimately assume that it's likely around $12,000 in net income. $12,000 in net income a year. So that'd be after all expenses paid, carrying costs, HOA dues, et cetera, et cetera. And so you can calculate ultimately the return on investment on a transaction like that. So in it for $37,500 plus another $8,000, and then about $12,000 in net income coming back in on an annual basis. Okay, I wanted to also take you through, and one of the things that we had requested was, okay, let's look at average purchase prices per year. And some of this data, some of you may have already been exposed to. A lot of it is sort of obvious, just having a pulse on the real estate investment marketplace and looking at properties on the MLS. But here's the average purchase price per year from 2008 to 2018 amongst equity trust self-directed IRA investors. You'll see a little bit of what's interesting here. You see prices rising, as you should, and then you see the average purchase price drop in 2015 to 16, which is interesting to analyze, okay, what was actually going on there. The only assumption we can make is that investors amongst equity trust clients that are more investor focused, of course, because they're buying these properties for investment purposes, as an IRA can really only be used for investment purposes. You can't personally be living in the property. That there was a lot of value buys, if you will, occurring in 2015 to 2016. So then what I did is I said, okay, let's bounce this against a national database. So, of course, Zillow, being a big name, was chosen as a data aggregator to pull some data and overlay that with our previous slide. And so here's interesting. You'll see, of course, Zillow data shows that there was a steady upward trend from 2014 through 15, 16, 17, 18, etc. But again, there you see 2015, 2016. There were some value buys, or likely some value buys amongst equity trust self-directed IRA investors, which of course would, or you could make the assumption that would be more potential profitability in the IRA. All right, so I wanted to mention quickly the various types of accounts for those of you that are not familiar. It's not just a 401k rollover or a traditional IRA transfer. We talked about a Roth IRA and some of the tax advantages of that plan. There are some other plans as well. There are business plans, the SEP IRA, Simple IRA, Solo 401k. Those are self-direct. These are all self-directed accounts that you can potentially establish and fund through Equity Trust Company. And then there's some other self-directed accounts to be aware of: the Coverdell Education Savings Account, the CISA account for short, and then the Health Savings Account, HSA plan. And so a lot of people aren't familiar with the concept of being able to use these other self-directed tax-exempt investment arrangements to be able to buy and hold real estate or buy and flip real estate. And as we talk about these different types of accounts, I want to mention partnering. So we went through a case study earlier on in the presentation about partnering multiple IRAs together, or partnering an IRA with a non-IRA investor. What we wanted to look at is, okay, are people partnering their IRAs together? And how many IRAs are they using to partner? Because really, it's unlimited. I've seen transactions where there's up to 10 IRAs involved in one transaction. So of all the partnering transactions, 83% use 2 accounts, 7% used 3 accounts, and 9% used 4 accounts, and then last but not least, it was about 1% used 5 or more. So those are pretty small percentages, and the reason why I have this slide up here is not to make a compelling argument that there's an incredible amount of people that are out there doing this. There's not an incredible amount of people out there that are doing this, and that's because there's just unfortunately not enough education out there on how to do it, and that people are doing it and that you can do it. You know, a lot of people are even told that they can't partner multiple IRAs together, or they might go to their custodian or administrator and they tell them that they don't have the infrastructure to be able to allow someone to do that. So it's important to know that these things are occurring and people are affecting real estate transactions through partnering multiple IRAs together. And just for imagery purposes, I wanted to put this slide up. This is a slide that we shared at our national annual Wealth Building Summit this past year in August here in Cleveland, Ohio, across from our corporate headquarters. And it was a slide that really a lot of people were able to bite onto, and a lot of people were able to start to formulate their own orbit. So I'll call this a constellation or an orbit. So as you conduct your 2019 planning, be thinking about what types of plans do I need, what types of plans can I open and fund, and how can I ultimately create more tax advantage dollars. That's what it's all about. It's about a tax advantage dollar being put into an account. You invest with that tax advantage dollar. That tax advantage dollar creates more tax advantage dollars, and you're leveraging compounding interest in the absence of taxation. If you're writing information down, that's something to write down. Compounding interest in the absence of taxation. It's a very, very, very powerful concept. All right, quick case study on partnering IRAs together. We showed you one before. This is Brian from Tennessee, 2017 Investor of the Year. Transaction number 1, and let me back up a moment and mention he made, and the reason why he was named Investor of the Year is he made $130,000 tax-free in just 1 year. And that was amongst 5 investment accounts. So the first transaction, he had 3 covered education savings accounts, and he bought a vacant lot for $8,000, partnering one CSA at $2,000, second CSA at $2,000, third CSA at $4,000. So it was a 50% CSA number 1, 25% CSA number 2, 25% CSA number 3 split. He then sold this to a local developer, and it was about 90 days from bought to sold. 60-day close, $60,000. So he made a $52,000 tax-free profit in those 3 CSA accounts, and it was split 50% went into CSA 1, 25% into CSA 2, 25% into CSA 3. Transaction number 2, same location, found another vacant lot. Well, actually, it was a lot. There was a property that needed to be demolished. He bought the lot for $120,000. So there were 2 side-by-side lots. Bought it for $120,000. It was subdivided into 3 lots, and then subsequently he sold it to a developer that built these townhomes. Sold it for $200,000, and he used 5 IRAs and investment accounts. He had 3 CSA accounts, and then his Roth IRA and his wife's Roth IRA. So all 5 investment accounts together, bought it as tenants and common owners for $120,000, sold it for $200,000, making an $80,000 profit. So again, in 1 year, Brian, being named the 2017 Investor of the Year, made $130,000 tax advantaged. All right, last but not least, in terms of the data, what we wanted to look at is investing in notes or making loans. And so what this slide shows you is the number 1, values of loans that are being made. So this could be an investor either loaning money from their IRA to like a rehabber or an investor, or buying an existing performing or non-performing note. So when we look at IRAs making loans to investors, and we look at yields as well, you'll see here the highest concentration of values of loans are between this $25,000 to $100,000. The highest concentration, 31% of all loans, 31% of all loans were between $50,000 to $100,000. And then when we get to the 2 years plus, 2+ years, this was again less than 2 years, When we get to the 2+ years, you'll see the highest concentration is $25,000 to $50,000. So all told, you could say that a majority of loans that are made or notes that are bought with IRAs are between $25,000 to $100,000. And I want to step back a moment to our partnering concept. If you're making loans secured by real estate to investors, you can also partner multiple IRAs together. So one of the most common partnerships we see is where an investor has a traditional and a Roth IRA. And let's say they're making a $50,000 loan, and they loan $25,000 from their Roth, $25,000 from their traditional. So the lender on the promissory note and mortgage or deed of trust is going to be listed as Equity Trust Company, Custodian, FBO, the client's traditional IRA, undivided interest 50%, and then Equity Trust Company, Custodian, FBO, the client's Roth IRA, undivided interest 50%. And it could be carved up 75-25, 80-20. It just has to be done proportionally. And it could, again, just like we talked about before, be more than just 2 IRA investors. Maybe it's 3 IRAs or 4 IRAs or 5 IRAs, just depending on the investor's needs and ability to be able to fund the various accounts that they're looking to open and fund. And then last but not least, as we look at interest rates or yield of those particular loans, you'll see that 77 for loans that are made with a maturity of 2 years or less, 77% are commanding a yield of 10% or greater. I'm just going to stop there a moment and kind of let everyone think about that. 77%. So a vast majority of loans that are made 2 years or less, these would be like your short-term rehabber loans, if you will, are commanding a yield of 10% or greater. For the 2 years plus maturity, you're looking at 50% command a yield of 10% or greater. And then as you can see, nearly 100% are commanding a yield between 7 to 10+%. So again, this is investors using their IRA to make a loan secured by real estate. Okay, last but not least, I mentioned building a team. So it's important that step one, you are working with a self-directed IRA custodian. So critical that you're working with a custodian that is going to meet your specific needs. Equity Trust Company as a custodian, we talked a little bit about how we're a passive custodian. I talked a little bit about the My Equity real estate investment portal. Important to look for a custodian that is on the leading edge, if you will, of technology tools and being able to streamline and sort of automate your self-directed IRA business. A little bit about Equity Trust Company. We've been in business for over 40 years. We have over 130,000 customers nationwide, and we focus on the custody of unique types of alternative assets, primarily real estate, notes, private equity. I mentioned digital currency in there, precious metals. So there's some other flavors, if you will, if you wanted to get involved in. You could do that through your Equity Trust account as well. Secondly, you're going to want to look at building a team comprised of not just, of course, your custodian, but a real estate attorney and or title company. And when identifying a real estate attorney and or title company, you want to look for someone that might have some experience with self-directed IRAs. Doesn't mean that they have to. They, of course, can go out and get a lot of education and learn what they need to learn. It's not vastly different than affecting a transaction outside of an IRA. In IRA, it's really just the IRA titling is a little bit different, and there's a few other nuances, but relatively speaking, it's all the same. So, but you want to make sure you have a good real estate attorney or title company in order to affect transactions with. And with that, it's also important if you're going to make loans with your IRA that you have a good real estate attorney, that you can get good documentation, promissory note, mortgage, deed of trust, and those types of documents to protect yourself. Of course, if you're looking for properties, you're not doing it all on your own. You want a realtor, somebody, a licensed professional that can help you identify properties. CPA. Particularly if you are opening like a solo 401k or a SEP IRA or some other type of small business plan, or you're going to do a Roth conversion, it's important to have a CPA to kind of help you run through those numbers. Tax attorney could potentially be somebody that you need on your team, especially if you're going to do advanced transactions. Construction company and contractors. So important to understand that you personally cannot do the work yourself. So the rule of thumb that's used in the industry, if your IRA owns a property, you personally as a disqualified person nor any other disqualified persons can do any of the sweat equity. The rule of thumb that's used is you can do the desk work, but you can't do the sweat equity. So with that, it may be good for you to consider using a property management company. You don't have to use a property management company, but should you choose to do that, especially for those that are out-of-state investors, that might be something that is applicable to you. So how do you identify these team members, find these team members, and begin to work with these team members? Networking would be something you would want to consider. A lot of people ask me, John, how do I find these people? How do I network? What I always let folks know is there's a lot of real estate investor workshops and meetups all throughout the country. In fact, if you go to IRAevents.com, you'll find we do a Saturday class all across the country. That's an opportunity. And then there are also local real estate investor meetup groups. Some of these are called real estate investor associations. So if you just do an internet search in your local area and look for real estate investor association or real estate investor meetup group, you should be able to identify groups that meet, like, let's say once a month, and they talk about different types of ways in which and different types of strategies to invest in real estate. And we find that investors will go to these meetings and they'll find real estate attorneys. They'll find CPAs and contractors and realtors and wholesalers and all of the people that they need to build their real estate investment team. And then when you come to Equity Trust Company, chances are very, very good that the people within that group know Equity Trust because we have a huge percentage of the market share in the self-directed real estate space. So it wouldn't come as a big surprise when you go to these meetup groups and you meet these individuals and you find these opportunities that they're accustomed to working with Equity Trust Company. They're accustomed to effecting real estate transactions through Equity Trust Company. So that being said, we're going to go ahead and start to close down here. If you're interested in the report, I would encourage you to email us at webinars@trustetc.com, and we'll get that report sent right out to you. Also, we will send you a free download of the Self-Directed IRAs Building Retirement Wealth Through Alternative Investing book. This book, over 200 pages, filled with case studies and tutorial guides and links to webinars and a lot of other content. This was written by our company founder, Dick Desich, who's widely known as the pioneer of the self-directed IRA industry. So 2 really, really great resources for you to expand on the webinar training we did today. And last but not least, if you're somebody that is interested in getting started, you know that self-directing an IRA or CISA or HSA makes sense to you, I would encourage you to email us as well at webinars@trustetc.com or just give us a call. Let us know that you joined today's webinar, and we can facilitate assisting you in establishing and funding a self-directed IRA. So without further ado, I want to thank everybody for joining us on today's webinar, and we look forward to seeing you on the next one.